Do you want to solve your financial problem? Follow my channel Mr. Swan, and lot of fun and informative videos can be found on this channel. Hit subscribe. Let's learn smarter, not harder. Asterisk.
Passive income can be a great way to help you generate extra cash flow, whether you're running a side hustle or just trying to get a little extra dough each month, especially as the sting of high prices and the aftermath of new tariffs hits consumers hard. Passive income can help you earn more during the good times and tide you over if you suddenly become unemployed, if you voluntarily take time away from work, or if inflation keeps chipping away at your purchasing power. With passive income, you can have money coming in even as you pursue your primary job, or if you're able to build up a solid stream of passive income, you might want to kick back a little. Either way, generating passive income gives you extra security. And if you're worried about being able to save enough of your earnings to meet your retirement goals, building wealth through passive income is a strategy that might appeal to you, too. If you're thinking about creating a passive income stream, check out these strategies and learn what it takes to be successful with them while also understanding the risks associated with each ideas. Passive income ideas for creatives. 1. Write an ebook. Writing an ebook can be a good opportunity to take advantage of the low cost of publishing and even leverage the worldwide distribution of Amazon to get your book seen by potentially millions of would-be buyers. Ebooks can be relatively short, perhaps 30 to 50 pages, and can be relatively cheap to create since they rely on your own expertise. You'll need to be an expert on a specific topic, but the topic could be niche and use some special skills or abilities that very few offer but that many readers need. You can quickly design the book on an online platform and then even test market different titles and price points. But just like with designing a course, a lot of the value comes when you add more ebooks to the mix, drawing in more customers to your content. Opportunity. An ebook can function not only to deliver good information and value to readers, but also as a way to drive traffic to your other offerings, including audio or video courses, other ebooks, a website, or potentially higher value seminars. Risk. Your ebook has to be very strong to build up a following, and then it helps if you have some way to market it, too, such as an existing website, a promotion on other relevant websites, appearances in the media or podcasts, or something else. So you could put in a lot of work up front and get very little back for your efforts, especially at first. And while an ebook is nice, it will help if you write more and then even build a business around the book, or make the book just one part of your business that strengthens the other parts. So your biggest risk is probably that you waste your time with little reward.
2. Sell photography online. Selling photography online might not be the most obvious place to set up a passive business, but it could allow you to scale your efforts, especially if you can sell the same photos over and over again. To do that, you might work with an organization such as Getty Images, Shutterstock, or Alamy. To get started, you'll have to be approved by the platform, and then you license your photos to be used by whoever downloads them. The platform then pays you every time someone uses your photo. You'll need photos that appeal to a specific audience or that represent a certain scene, and you'll need to tease out where the demand is. Photos could be shots with models, landscapes, creative scenarios, and more, or they could capture real events that might make the news. Opportunity. Part of the value of selling or licensing your photos through a platform is that you have the potential to scale your efforts, especially if you can provide pictures that will be in demand. That means you could potentially sell the same image hundreds or thousands of times or more. Risk. You could add hundreds of photos to a platform such as Getty Images and not have any of them really generate meaningful sales. Only a few photos may drive all of your revenue, so you have to keep adding photos as you search for that needle in the haystack. It may require substantial effort to go out and shoot photos, then process them and keep up with the events that may ultimately drive your revenue, and motivation could be hard to maintain. Every next photo might be your lottery ticket, though it almost certainly won't be. 3. Create an app. Creating an app could be a way to make that upfront investment of time and then reap the reward over the long haul. Your app might be a game or one that helps mobile users perform some hard-to-do function. Once your app is public, users download it, and you can generate income. Opportunity. An app has huge upside. If you can design something that catches the fancy of your audience, you'll have to consider how best to generate sales from your app. For example, You might run an app ads or otherwise have users pay a nominal fee for downloading the app. If your app gains popularity or you receive feedback, you'll likely need to add incremental features to keep the app relevant and popular. Risk. The biggest risk here is probably that you use your time unprofitably. If you commit little or no money to the project or money that you would have spent anyway, for example, on hardware, you have little financial downside. However, it's a crowded market and truly successful apps must offer a compelling value or experience to users. You'll also want to make sure that if your app collects any data that it's in compliance with privacy laws, which differ across the globe. The popularity of apps can be short-lived, too, meaning your cash flow could dry up a lot faster than you expect.
4. Create a blog or YouTube channel. Are you an expert on travel to Thailand? A maven of Minecraft? A sultan of swing dancing? Take your passion for a subject and turn it into a blog or a YouTube channel, using ads or sponsors to generate your income. Find a popular subject, even a small niche, and become an expert on it. At first, you'll have to build out a suite of content and draw an audience, but it can create a steady income stream over time as you become known for your engaging content. Opportunity, you can leverage a free or very low-cost platform, then use your great content to build a following. The more unique your voice or area of interest, the better for you to become the person to follow. Then draw sponsors to you. Risk, you'll have to build out content at the start and then create ongoing content, which can take time. And you'll need to be really passionate about the product, since that can help you maintain the motivation to continue, especially at the start as your followers are still finding you. The real downside here is that you can outlay a bunch of your time and resources with little to show for it if there's limited interest in your subject or niche. Your area of expertise may be too niche to really draw a profitable audience, but you won't be sure of that until you experiment. 5. Sell designs online. If you have design skills, you may be able to turn them into a moneymaker by selling items with your printed designs on them. Businesses such as Cafris and Zazzle allow you to sell items including t-shirts, hats, mugs, and more with your own designs. Opportunity, you can start with your own designs and see what the market is interested in and expand from there. You may be able to capitalize on the surging interest in a current event and design a shirt that captures the spirit of the times, or at least a snarky take on it. And you can also set up your own web storefront through a site such as Shopify to market your goodies. Risk. Printing partners allow you to ship items without directly investing in the merchandise yourself, avoiding one of the biggest risks of tying up your capital. But you may be able to get better pricing if you invest in some of the inventory yourself. Another big risk here is that you could invest a lot of time with little payoff, but this avenue might be interesting if you're already doing the design work for another purpose, such as personal interest.
6. Dividend stocks. Shareholders in companies with dividend-yielding stocks receive a payment at regular intervals from the company. Companies pay cash dividends on a quarterly basis out of their profits, and all you need to do is own the stock. Dividends are paid per share of stock, so the more shares you own, the higher your payout. Opportunity, since the income from the stocks isn't related to any activity other than the initial financial investment, owning dividend-yielding stocks can be one of the most passive forms of making money. The money will simply be deposited in your brokerage account. Risk. The tricky part is choosing the right stocks. For example, companies issuing a very high dividend may not be able to sustain it. Too many novices jump into the market without thoroughly investigating the company issuing the stock, warns John H. Graves, author of The 7% Solution. You can afford a comfortable retirement. You've got to investigate each company's website and be comfortable with their financial statements, Graves says. You should spend 2 to 3 weeks investigating each company. That said, there are ways to invest in dividend-yielding stocks without spending a huge amount of time evaluating companies. Graves advises going with exchange-traded funds or ETFs. ETFs are investment funds that hold assets such as stocks, commodities, and bonds, but they trade like stocks. ETFs also diversify your holdings, so if one company cuts its payout, it doesn't affect the ETF's price or dividend too much. Here are some of the best ETFs to choose from. ETFs are an ideal choice for novices because they are easy to understand, highly liquid, inexpensive, and have far better potential returns because of far lower costs than mutual funds, Graves says. Another key risk is that stocks or ETFs can move down significantly in short periods of time, especially during times of uncertainty, as in 2020 when the coronavirus crisis shocked financial markets. Economic stress can also cause some companies to cut their dividends entirely, while diversified funds may feel less of a pinch. Compare your investing options with Bankrate's brokerage reviews.
7. A bond ladder. A bond ladder is a series of bonds that mature at different times over a period of years. The staggered maturities allow you to decrease reinvestment risk, which is the risk of reinvesting your money when bonds offer too low interest payments. Opportunity. A bond ladder is a classic passive investment that has appealed to retirees and near-retirees for decades. You can sit back and collect your interest payments, and when the bond matures, you extend the ladder, rolling the principal into a new set of bonds. For example, you might start with bonds of 1 year, 3 years, 5 years, and 7 years. In a year, when the first bond matures, you have bonds remaining of 2 years, 4 years, and 6 years. You can use the proceeds from the recently matured bond to buy another 1 year or roll out to a longer duration, for example, an 8-year bond. Risk. A bond ladder eliminates one of the major risks of buying bonds, the risk that when your bond matures you have to buy a new bond when interest rates might not be favorable. Bonds come with other risks, too. While Treasury bonds are backed by the federal government, corporate bonds are not, so you could lose your principal if the company defaults. And you'll want to own many bonds to diversify your risk and eliminate the risk of any single bond hurting your overall portfolio. If overall interest rates rise, it could push down the value of your bonds. Because of these concerns, many investors turn to bond ETFs, which provide a diversified fund of bonds that you can set up into a ladder, eliminating the risk of a single bond hurting your returns. 8. A high-yield CD or savings account. Investing in a high-yield certificate of deposit CD or savings account at an online bank can allow you to generate a passive income and also get one of the highest interest rates in the country. You won't even have to leave your house to make money. Opportunity. To make the most of your CD, you'll want to do a quick search of the nation's top CD rates or the top savings accounts. It's usually much more advantageous to go with an online bank rather than your local bank because you'll be able to select the top rate available in the country. And you'll still enjoy a guaranteed return of principal up to $250,000 if your financial institution is backed by the FDIC. Risk. As long as your bank is backed by the FDIC and within limits, your principal is safe. So, investing in a CD or savings account is about as safe a return as you can find. But that return can pale in comparison to inflation, hurting the real purchasing power of your money. Nevertheless, a CD or savings account will yield better than holding your money in cash or in a non-interest-bearing checking account where you'll receive nothing.
9. Set up an annuity. An annuity can be a good place to set up reliable income. With a typical annuity, you make payments to an insurance company which will provide you with a stream of income in the future. Annuities pay out monthly, and they can be set up in a variety of ways, for example to start paying immediately or much later. Opportunity. Annuities can be structured in multiple ways, depending on exactly what you need, but they're the definition of passive income. If you want a monthly payout immediately, the insurance company can set that up, or you can structure the payment to start when you retire, for example. In addition, you can set up an annuity that has a fixed return or one that could offer a variable payout depending on how the annuity's underlying investments performed. An annuity can be set up to pay out for a set period, say 20 years or a lifetime. It could cease payments on your death, or it could continue paying out to your spouse. The options are wide. Risk. Annuities are tremendously complex, and when you set one up, you're often locked in for a long time, though you may be able to get out of one by paying a significant penalty. Read the fine print on the contract carefully so that you understand the pros and cons of the specific contract. You also typically need to hand over a large chunk of money to the insurance company to fund the annuity. Every annuity contract is different, and each may offer a unique set of benefits in order to cater to your specific needs. So, it's vital to understand what you're signing up for. 10. Peer-to-peer lending. A peer-to-peer P2P loan is a personal loan made between you and a borrower, facilitated through a third-party intermediary such as Prosper. Other players include Lending Club and Upstart. Opportunity. As a lender, you earn income via interest payments made on the loans. But because the loan is unsecured, you could end up with nothing in the event of a default. To cut that risk, you need to do two things. Diversify your lending portfolio by investing smaller amounts over multiple loans. At Prosper.com, the minimum investment per loan is $25. Analyze historical data on the prospective borrowers to make informed picks. Risk. It takes time to master the metrics of P2P lending, so it's not entirely passive, and you'll want to carefully vet your prospective borrowers. Since you're investing in multiple loans, you must pay close attention to payments received. Whatever you make in interest should be reinvested if you want to build income. Economic recessions can also make high-yielding personal loans a more likely candidate for default, so these loans may go bad at higher than historical rates when the economy worsens. 11. A municipal bond closed-end fund. Municipal bonds offer tax-free dividend income to investors in exchange for financing public projects for states and cities. A closed-end fund focused on this area of the market owns a variety of these bonds and then juices the overall return by borrowing money to buy more. Like investing in CDIs or dividend funds, a closed-end fund is the most passive kind of income. Opportunity. A closed-end municipal bond fund may be an attractive way to earn tax-free income, which may be especially true for those in high-tax states or high-tax brackets. These funds typically pay better dividends than an average municipal bond because they use leverage itself a risk, though a fund owns a variety of different bonds, helping to reduce overall risk. Closed-end funds should usually be purchased at a significant discount to their net asset value, helping reduce risk too. Risk, bond prices, and therefore the price of bond funds decline when interest rates rise and vice versa. But a closed-end fund's leverage magnifies this effect, so the average fund will decline more than the average bond in a downturn. At the same time, the bond fund may need to cut its payout in order to pay increased expenses on its borrowing, hitting the fund's price still more. So a closed-end fund can be volatile as rates shift quickly. 12. Preferred stock. Preferred stock is a type of stock that acts more like a bond, making attractively large dividend payouts on a quarterly schedule. Like bonds, preferred stock has a face value and may have a specific maturity, though it may also be perpetual, meaning the company need never redeem it. Typically, it can be redeemed after 5 years of issuance. Preferred stocks trade on an exchange, so you can buy them easily, and liquidity is relatively good. Opportunity. Preferred stock can pay out larger than usual dividends compared to a company's bonds, but that's in exchange for foregoing a capital gain unless you buy preferreds at a discount to their face value. But it can be an attractive way to earn a passive return. Many REITs, banks, and other financial companies issue preferreds to finance their operations. Risk. Preferred stocks trade on an exchange, meaning that their prices will fluctuate, particularly in response to changes in prevailing interest rates. As rates rise, the price of preferreds will likely fall, and vice versa, though the price likely won't rise much above face value. And like bonds, you'll need to carefully understand the company and its ability to pay its dividends, or your investment could permanently decline value. If you don't want to pick individual preferred stocks, then opt for a preferred stock fund. You'll get a diversified collection of preferreds, reducing your risk.